Imagine you suddenly have extra money every month. Maybe a raise, a side income, or simply better financial discipline. Now you face one of the biggest money decisions adults make. Should you invest that money or use it to pay off your mortgage faster? On paper, the answer seems mathematical. Interest rates, investment returns, compounding, simple. But in reality, this decision is deeply psychological. Because money decisions are never just about maximizing numbers. They're about fear, security, control, stress, freedom, and identity. Some people feel trapped until their house is fully paid off. Others see early mortgage payoff as a financial mistake. So who's right? And what actually happens to your finances depending on the path you choose? Today, we're breaking down the real psychology, risks, and long-term consequences behind one of the most debated financial decisions in modern life. For many people, a paid-off home represents safety, not just financially, emotionally. The mortgage is often the largest monthly bill in a person's life, and psychologically, debt creates pressure, even manageable debt. Every month, the payment returns, again and again, for decades. That repetition quietly affects how people feel about money. So when someone imagines owning their home outright, they imagine peace. No bank, no monthly obligation, no fear of losing the house if income changes. This emotional relief is powerful. In fact, many people aren't trying to maximize wealth. They're trying to minimize anxiety. And paying off a mortgage can absolutely reduce stress. That matters more than spreadsheets often admit. Now, mathematically, investing often appears stronger. Historically, long-term investment returns have frequently exceeded mortgage interest rates. So financially, many people argue, why aggressively pay off low-interest debt when investments may grow faster? And logically, that makes sense, especially during periods where mortgage rates are relatively low, markets perform strongly, inflation reduces debt burden over time. This is where compounding becomes powerful. Money invested early has time to grow exponentially. Meanwhile, extra mortgage payments produce guaranteed savings, but not explosive growth. So, on paper, investing may create higher net worth. But human behavior complicates this dramatically. Because theoretical returns and real behavior are not the same thing. This is the part financial discussions often ignore. Behavior. Many people say, I'll invest instead of paying extra toward the mortgage. But then, they don't invest consistently. The extra money slowly disappears into lifestyle inflation, shopping, vacations, cars, food delivery, random spending. Psychologically, money that stays available often gets consumed. This is called lifestyle absorption. The mortgage payoff strategy works partly because it forces discipline. It converts extra income into locked equity. Meanwhile, investing requires ongoing emotional consistency, patience during downturns, discipline during uncertainty, long-term thinking. And most humans struggle with all three. So the best strategy on paper often fails in real life because of behavior. Some people can sleep peacefully carrying a mortgage for 30 years. Others can't. Why? Because humans experience financial risk differently. Two people can have identical finances and completely different emotional reactions. One person sees leverage as efficient. Another sees debt as vulnerability. One values maximizing returns. Another values certainty. This is why personal finance is deeply personal, because the mathematically optimal path may feel emotionally unbearable. And emotions matter. A financially efficient strategy that creates constant stress may not actually improve quality of life. Meanwhile, someone with a paid-off house may technically have lower investment growth, but dramatically lower anxiety. That psychological stability can affect career decisions, family stress, health, sleep, risk tolerance. Money is never just arithmetic. It's emotional architecture. One fascinating effect of mortgage freedom is behavioral transformation. When people fully own their home, something shifts psychologically. Monthly pressure decreases. Fear decreases. Financial breathing room increases. And suddenly, people may save more confidently, take smarter risks, invest more consistently, change careers, start businesses, reduce panic around money. Because cash flow changes behavior. A paid-off house lowers required monthly survival costs. That creates flexibility. And flexibility is a form of wealth many people underestimate. Because financial freedom isn't only about net worth. It's about how much control you have over your life. At the same time, investing creates a different kind of freedom. Liquidity, opportunity, growth. Unlike home equity, investments can often be accessed more flexibly. And investments may continue compounding for decades. That creates optionality. The ability to retire earlier, relocate, handle emergencies, build passive income, create multi-generational wealth. This is why many financially sophisticated people prioritize investing, because they understand the long-term power of assets growing over time. But again, this only works if the investing actually happens. Not theoretically, consistently, emotionally, disciplined over years. People often ask, which strategy is better? But that question is incomplete. A better question is, which strategy fits your behavior, psychology, and goals? Because wealth building is not just optimization, it's sustainability. The best strategy is often the one you can continue calmly for decades. Some people build wealth through aggressive investing. Others build stability through debt elimination. And many successful people combine both. Invest steadily. Reduce debt steadily. Build flexibility gradually. Because sustainable financial behavior usually beats extreme financial optimization. So, should you invest or pay off your mortgage? The truth is, both can build wealth. Both can fail. Because the outcome depends less on formulas and more on human behavior. Discipline, consistency, emotional control, risk tolerance, long-term thinking. A mortgage is not just debt, and investing is not just math. Both are emotional decisions disguised as financial ones. And understanding your own psychology may matter more than choosing the perfect strategy. If you enjoyed this documentary, subscribe for more psychology-based finance content. Because the most important part of money is rarely the numbers. It's the behavior behind them.